Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome to Aviation Intelligence Weekly. I'm Sarah, and with me is Mike. Today we're diving into General Dynamics Q1 2026 10Q filing, released April 29th. Mike, this is a defense and aerospace giant with significant business aviation exposure through their Gulfstream operations.
That's right, Sarah. General Dynamics operates across 4 segments: aerospace, marine systems, combat systems, and technologies. While they're not a pure-play aviation company like the airlines we typically cover, their aerospace segment gives us critical insights into the business aviation market, which often serves as a leading indicator for broader aviation trends.
Let's get right to it then. If we reduce this filing to one sentence, what's your core thesis?
If we reduce this filing to one sentence, it's this: General Dynamics is operating as a defense contractor at peak cycle demand, with business aviation providing margin expansion leverage in a supply-constrained environment. Based on this filing, General Dynamics is operating in late cycle peak conditions. The MD&A explicitly states that defense spending has been at increased levels, and the administration has publicly stated support for further increases, while their aerospace segment is experiencing what management calls strong demand for business jets. This combination of government spending, peaks, and luxury aviation demand typically signals we're in the late stages of an expansion cycle.
That's a bold positioning call. Let's test that thesis against the material changes. What shifted significantly versus prior periods?
The numbers tell a compelling story, Sarah. Revenue hit $52.55 billion with operating income of $1.42 billion. The standout change was marine systems revenue growing over 20%. That's the exact language from the MD&A. Over 20% growth in our marine systems segment, driven by increased material volume. When you see defense shipbuilding growing at that pace, you're typically looking at a government spending surge that's unsustainable long term.
And the margin picture?
Here's where it gets interesting. Consolidated operating margin increased 10 basis points, but the segment level story is more nuanced. Aerospace operating margin jumped 70 basis points. That's significant margin expansion in business aviation. For context, business aviation operating margins typically run in the mid to high teens during strong cycles, so 70 basis points of expansion suggests they're pushing toward peak profitability levels.
Walk me through the causality chain there.
If this margin expansion persists in aerospace while defense spending maintains these elevated levels, then General Dynamics hits a profitability peak that becomes difficult to sustain. When business aviation margins compress, and they always do in cyclical downturns, the company's overall profitability profile changes dramatically. That's what makes this a late cycle peak thesis, rather than mid-cycle expansion.
Let's examine management's commentary. What signals are you picking up from their language?
Management's tone is notably confident, but with embedded caution. In the business environment section, they state, "We have invested significantly in our facilities and workforce to increase production capacity to meet this demand, and expect to continue to do so." That's aggressive capacity expansion language. But then they add this crucial qualifier about the shipbuilding industrial base being already impacted by significant demographic issues coming out of the global pandemic.
That sounds like they're acknowledging constraints even as they're expanding.
Exactly. And in combat systems, management explicitly says, "We expect short-term combat vehicle production volumes to be down slightly as the Army reviews funding priorities." When a defense contractor is calling out near-term volume declines while simultaneously investing in capacity, that's classic late-cycle behavior. They're betting on sustained demand that may already be showing cracks.
What about the international picture they're painting?
Management is bullish on European demand, stating they've seen increased demand, particularly in Europe, for our combat systems military products and services due to regional conflicts. But they immediately flag that there will be increased pressure on the supply chain and our hiring of skilled workers. This is a high-wire execution scenario with limited margin for error. They're chasing international growth while their domestic supply chain is already strained.
Let's shift to financial red flags or confirmations. What's the balance sheet telling us?
The balance sheet actually looks quite solid, which is interesting. They're sitting on $3.65 billion in cash and equivalents against $1.75 billion in current debt and $8.07 billion in long-term debt. That's a manageable debt load for a company of this size. However, there's a timing issue. Management notes they have $500 million each maturing in June and August 2026 and are evaluating refinancing options.
So liquidity isn't the immediate concern?
Not immediate liquidity, but capital allocation efficiency. They increased capital expenditures 43% to $203 million in Q1 and expect CapEx to remain elevated through 2026. If you're expanding capacity at peak cycle while managing debt refinancing, the margin for error narrows significantly. If demand softens while they're carrying elevated fixed costs from this expansion, that's where the late cycle risk materializes.
Any going concern language or working capital stress?
No going concern issues whatsoever, but the working capital story is telling. They're building inventory and capacity to meet what they see as sustained demand. The causality chain here is, if defense spending plateaus or business aviation demand softens while they're carrying this expanded cost structure, then return on invested capital deteriorates rapidly, and that changes the entire investment thesis.
What about risk disclosures? Any new concerns flagged?
Interestingly, the filing notes no new or significantly escalated risk factors identified versus prior filing. That's actually somewhat concerning from a cycle perspective. When companies are expanding aggressively, but not updating their risk disclosures, it can suggest management confidence that may be misplaced.
They did mention some operational risks, though, right?
Yes, supply chain disruptions are real. Management specifically calls out some delays, including at our Israel-based supplier of mid-cabin airframes, caused by conflicts in the Middle East. They also mention tariff impacts, though they note the Supreme Court ruling on IEEPA tariffs, and that these developments were not material to our results of operations. The supply chain issues are manageable now, but could amplify if demand stays elevated.
Let's talk liquidity and balance sheet stress more specifically.
From a liquidity standpoint, they're well positioned short term. The $3.65 billion cash position provides substantial cushion, but the debt maturity calendar creates some pressure. $1 billion in refinancing needs over the next few months, during a period when they're also investing heavily in capacity expansion.
How does that compare to typical defense contractor liquidity profiles?
Defense contractors typically maintain lower cash balances relative to revenue because of the predictable government contract cash flows. General Dynamics' cash to revenue ratio is actually quite healthy compared to peers. The concern isn't liquidity stress, but rather capital allocation during what appears to be peak cycle conditions.
Break down the segment level winners and losers for us.
Marine Systems is the clear winner with that 20% plus revenue growth and 30 basis points of margin expansion. Management attributes this to increased material and labor volume on Columbia-class and Virginia-class submarine construction. That's pure government spending surge.
And the other segments?
Aerospace delivered strong performance with 70 basis points of margin expansion from additional aircraft deliveries and improved services demand. Combat Systems grew revenue from artillery production and European vehicle programs, adding 20 basis points of margin from favorable program mix. Technologies was the relative laggard with only 10 basis points of margin decline despite revenue growth from C5ISR programs.
That's 3 out of 4 segments expanding margins. In the context of defense contracting, how unusual is that?
It's quite unusual and reinforces the late cycle peak thesis. Defense contractors typically see margin expansion when they're optimizing production on mature programs while government spending is elevated. When you get broad-based margin expansion across segments, you're usually looking at peak profitability conditions that are difficult to sustain.
Finally, what should traders and investors be monitoring, and what's your counter thesis?
Management provided full-year EPS guidance of $16.45 to $16.55. The key metrics to watch are defense appropriations levels, business aviation delivery schedules, and their capital expenditure execution. They're sitting on a backlog of $130.8 billion, up from $118 billion at year end, which provides revenue visibility but also creates execution risk.
What would prove your late cycle peak thesis wrong?
If defense spending sustains at these elevated levels through 2027, while business aviation margins hold above current levels, our late cycle peak thesis is wrong. Specifically, if aerospace operating margins stay above the current expanded levels, while marine systems maintains 20% plus growth rates, then this isn't peak cycle. It's a structural shift to higher baseline demand.
And how should investors think about valuation here?
At current margins, and with this backlog growth, this equity trades like a mid-cycle defense contractor, not a peak cycle performer. The market may not be fully pricing in the execution risk of expanding capacity while managing elevated demand across multiple segments simultaneously.
Does the full weight of evidence support your opening thesis?
The evidence strongly supports the late cycle peak thesis. You have margin expansion across segments, aggressive capacity investments, government spending at elevated levels with management acknowledging it, and supply chain constraints that limit upside while amplifying downside risk. The combination of defense spending, peaks, and business aviation strength historically signals late cycle conditions. The risk-reward profile here favors caution despite the strong current performance.
That wraps our analysis of General Dynamics Q1 2026 filing. Remember, this is for informational purposes only and not investment advice. I'm Sarah.
And I'm Mike. Thanks for listening to Aviation Intelligence Weekly.